Welcome to the Tech Today podcast. It's your host, John Maeda. We put out a note this morning on Bank of America. The big four banks reported earnings this morning. And we wanted to look at the unrealized losses. We've been writing about it for over a month. And, the banks, particularly the large banks, particularly Bank of America, got greedy when the Fed's funds rate was at the zero bound and bought a ton of debt. So Bank of America, as of September 30th, they had $136 billion in unrealized losses on their debt securities, $107 billion of which were in mortgage backs because they gorged on mortgage backs when they were at 2%. And that's a problem for banks because when you have massive unrealized losses on your balance sheet, you typically get very conservative in terms of lending, which is what happened back in March of last year, which is why the Fed instituted its BTFP bailout. The Bank Term Funding Program is a bailout, regardless of how the Fed positions it. The Fed apparently is going to let the BTFP expire on March 11th on the one-year anniversary. One of their officials spoke last week. And so when Bank of America reported today, so the quarter ending 12/30, the losses on their mortgage backs and the losses on their total debt securities came down approximately 25%. We have the details in our note, which I'll link to in the show notes. And so the Fed did BofA and the other banks, not only the other big four banks, but the banking sector in general, the Fed did them a big favor with the BTFP, which allowed these banks to mark up these securities, which were deeply underwater, to mark them fully up to par value, which frankly saved a lot of the banks. BofA, I believe, would have had an existential crisis without the Bank Term Funding Program. So when CEO Brian Moynihan is out there, or was out there all of 2023, saying that the banking sector was strong, I mean, what is he going to say? But no, the sector wasn't strong and his bank wasn't strong. Without the BTFP, his bank would have been toast, just like it frankly almost was back in 2008. So Moynihan ought to be fired, frankly. For the bank, for BofA to have taken such a large position in those various debt securities, particularly mortgage backs, when rates were down at the zero bound, and not have more cash on hand for a rainy day was irresponsible. So he was bailed out when he was COO of the bank back in 2008, and he's bailed out again. So he hasn't learned his lesson. His head ought to roll, and his whole team ought to be wiped out. That's what I would do if I were on the board. I'd recommend that Moynihan be terminated. The bank is going to be fine. The big four banks truly are too big to fail. As I said, their unrealized losses narrowed by 25% thanks to Powell in his dovish comments back in the middle of March at the FOMC meeting. So yields came in, thereby inflating bond prices. And now getting back to what I mentioned a moment ago about the BTFP, the Fed allowing that to expire on March 11th, well, that means rates, they have to come down. Not only do they have to come down, as I mentioned yesterday, to make these costs of servicing the national debt more manageable, but if you're going to if the goal is to reinflate the debt securities on bank balance sheets to eliminate those losses, the only way to do that is to take rates down. And not by 25 bips a quarter for the next 2, 3, or 4 quarters, but they're going to come down more sharply than the Fed is letting on, I believe. If they're truly, particularly if the Fed is truly going to allow the BTFP to expire, rates are going to come down pretty quick, probably around the time of the BTFP expiration, which again is March 11th of this year. So the Fed, as usual, doesn't show its cards, and its actions are usually very different than its words. The two are not congruent. That's all for now. See you next time.